بسم الله الرحمن الرحيم. We are going to talk about chapter 4. Okay? Chapter 4 is related to the risk and portfolio theory. First of all, I'm going to give a brief about the main objective of this chapter. Okay? The main objective. So this chapter will study the risk and how we measure the risk. The second objective of this chapter is to consider the relationship between risk and return. So we will introduce different measurements of return relative to the different measures of risk. And we will link between the risk management and portfolio theory. Why we are interested in risk in this area? Because as we know from the previous chapters that the return increase, as the return increases, the risk increases. But in the portfolio theory, it is different. As the return increases, we can keep the risk at minimum level. It is not necessarily that the return increases and in the same time the risk increases. And the efficient portfolio theory claims that the efficient theory depends on the minimum risk. And if we want to categorize managers based on the portfolio theory, the manager who has higher return and less risk is the more preferable manager. And in terms of portfolio theory, the main components of measuring the risk of portfolio is the correlation between the risk. Because when we include different assets in our portfolio, there is no correlation between return, but the correlation is between risk. This is why the importance of risk. First of all, we will introduce you to the components of return. Then we will talk about the risk, and after that we will combine between the risk and return and put it in the form of portfolio. Okay? So the portfolio theory and the trade-off between risk and return. As I explained before, just to remind you, this is the risk, okay, and here is the return. We claim that the market is efficient, as we explained in the previous chapter. So all of the securities are representing on the security market line. If we have A, B, C, D, and E, the required rate of return of A is, for instance, 9%. And then this is the sigma. Sigma is the measure of risk. For instance, could be 0.24. If in B, the investor of B asking higher rate of return, okay, so this is higher rate of return, could be 12%. As long as he or she asking higher rate of return, so he or she has to hold higher risk. Consider this is, for instance, 50%. The difference between the A and B is considered as a risk premium. Okay? So now we will focus first on the return. In the return, we have different types of return. Return income plus capital appreciation. Again, just to remind you, with the first chapter in the return, we have two sources of return: the income and the capital. And based on these two main sources of income, we calculate the return. Generally speaking, we have three different types of return. The first one is the expected return. The things we expect in the future. We anticipate this return in the future. And this is the required rate of return. This is what the investor is asking about the return. It could be the required rate of return is equal to the expected return, and could be not. And the realized rate of return, this is the actual one. Okay? So this is the expected rate of return that we expect in the future according to the availability of particular information and data. Then the required rate of return that we asking as investors. And finally, the realized rate of return, and this is related to the actual performance of the business. Okay, the first one, the expected rate of return. In terms of formulas, there is no big difference for the formulas when we do calculations. The expected rate of return is the anticipated, what we expect in the future, anticipated of income and price appreciation. This is income, and this is price appreciation. Price appreciation, it means the growth of the price. This is the growth. Let's construct this. If we want to calculate return, so in this case, we have income in terms of the dividends plus the growth. So it's D1 or D divided by B naught plus the growth. Okay, you can do it in different ways. You can do it in D divided by B naught plus B1 minus B naught divided by B naught. And this right hand side of the formula is the growth. The growth in the price. If the price is growing, it means we can expect capital gains. If the price is depreciated, you know what it means depreciated, so we expect a loss gain, as we explain again in the chapter 3. Okay? Sorry? D is the dividends. And if you have, this is for stocks, but if we are talking about the debts, you just replace this by interest, or if you are talking about the bonds, replace this by coupon rates. The growth is an indicator for the capital gains, which is the difference between the selling price and buying price. Okay? Well, D divided by B naught. We can rewrite the formula as retain is equal B1 or the B1 minus B naught divided by B naught plus the plus the dividends. Again, this is the growth and this is the dividends. Okay? Now, we will go back to this. Don't worry about this. We will explain this again. Okay, the required rate of return is the return necessary to induce investor to bear the risk associated with a particular investment. The required rate of return is represented in the security market line. This is required rate of return by the investors. And this is optimal. Okay? All of the required rate of return must be located on the security market line if we are working in the efficient markets. If we have inefficient markets, the required rate of return will be mistakenly below or above the security market line. But I'm not talking about the mispricing. I'm talking about the efficient markets. So in the efficient market hypothesis, the required rate of return by investors is located in the security market line and reflects the relationship between the risk and return. The more return you are acquiring, the higher risk you are holding. And as we explain in this chart, the required rate of return includes two components. The risk-free components, which includes the inflation rates and the R nominal, okay, plus the risk premium. Again, this is the investor may in alternative investments. So the investors, when he or she decides in the investment, they are thinking what other investors or what other investment tools or securities give him. He or she compare. This is the first thing. For instance, we have A and B. Investor looking about the A and B. But the link between risk and return is important, and they use the CV, or the coefficient of variation. Please write this, because this is not in your textbook. The coefficient of variation. Investors, when they evaluate the investment options, they try to look at the risk and return in the same time. I will give you example how investors doing this. If we have two options, option A and option B, and we have the return of A and we have sigma of A. Sigma is the standard deviation, which is a measure of risk or a proxy of risk. Okay? Now, if the rate of return of A is 10% and the rate of return of B is 15%. Now, if I'm asking you one little question, which you prefer, A or B? So it's B. It's from this data, from the given data, you easily say, okay, it's B. Okay? That's fine. Now, in terms of risk, if I give you this 24, this is the standard deviation, is this 24, and here is, let's see, 65. Now, in terms of risk, if both them together, which you prefer, A or B? By linking A, you still saying A. Why A? But lower return. So why you are not selecting B with the higher risk? Well, sorry, with the higher return. Why? Try to convince me. Sorry? But the return is higher.
If the investor is a risk taker, he will take option B. And if not, he will take option
Yes. So if the investor is a risk taker, he or she will take B. If the risk averter, he or she will go to the A. It means we don't have accurate answer. Some people saying A, others saying B. Okay, to leave this and to say A or B, we should use coefficient of variation, which is calculated by the, you know how we calculate this? Okay, the standard deviation, sigma, divided by the rate of return, R, or the expected rate of return. Now, let's calculate the CV, the correlation or the coefficient of variance. The first one is 0.24 divided by 0.10, and the second one is 0.65 divided by 15. The first one, 0.024, and the second 0.043. Okay. Any explanation for this? Okay, I will write this. The CV for A is 0.024. For B, it is 0.43. So, which you prefer and why? the coefficient of variance or the coefficient of variation for E is 0.24. It means this is 2.4% and this is 4.3%. So what it means then? The advantages of this CV is the link between the risk and return. Okay? So what it means? And which you prefer, A or B? A. Why A?
Because its relation with the risk is lower, which means apparently that it's...
Okay, the risk is lower. How? Explain this. Yes.
Because the risk compared with the return is little in A.
Yeah. It means if we invest, for instance, to take $1 return for A, we hold 2.4% risk. But to make $1 return for B, we hold 4.3%. So it means this is more preferable than, because it's holding lower risk. Okay? I mean in terms of $1 return. We are standardizing the risk and return in this. It means $1 return holding 2.4% risk. $1 return holding 4.3% return. So in this case, we prefer A because $1 holding lower risk. Okay. Now, let's go to the second assumption. The investors, they do analysis for different securities, and they apply different methodologies, like they calculate the return, the risk, and the CV. Then the second, a premium of bearing risk. A premium of bearing risk, as I explained, the more risk you are holding, the higher return you are asking. Okay, and this is the premium is for the individual risk. If we go back to this, we know this is the systematic risk, and we will explain what it means, systematic risk, and this is unsystematic risk. The systematic risk influences all of the securities, but the unsystematic risk is a standalone risk or firm-based
Related
risk.
to the company.
So the more the firm risk, the more we have risky firm, the more we asking the higher return. Okay, so the compensation here is not because of the systematic risk, because of the unsystematic risk. Because the systematic risk already reflected in the risk-free. The realized return, which is the actually obtained by the investors, the realized return is the return actually earned on investment, and essentially the sum of the flow of income generated by the asset and the capital gains. And I show you how the now the risk. We introduced the return, now the risk. The risk is the uncertainty associated with the earning the expected return. Is the uncertainty of having both the income return and the capital gains. Okay? Because we are not certain to having these particular return or particular flow of income. The sources of risk. As I explained, we have two main sources of risk. We have the systematic risk and we have unsystematic risk. The systematic risk is non-diversifiable. Yes. Okay? And we mentioned this before, and this is unsystematic risk. They just to remind you, this area is the systematic risk. and this area is the unsystematic risk. The unsystematic risk is related to the fund-based. And it includes, as you see here, it includes business risk and financial risk. Business risk is related to the running the business. For instance, the delegation, the competitors, the growth of this business. We can talk about the sales management, the criteria of managers, the skills of employees. All of these things related to the business environment. The financial risk is related to the financial status of the business. We can talk about the balance sheets components. We can talk about the income statement, the cash flow statement, and the other related, the budgets also. All of these statements help us to determine the financial position of the company. So if the company have, look at here. If we have company A and company B, if company A has less unsystematic risk, it means we asking lower rate of return. Okay? And if B is greater than, if I ask you, we have A, B, C. A has individual risk, which measured by sigma. Sigma is equal 0.24, okay? And here sigma is equal, let's say, 0.15, and here sigma is equal 0.10. Now, please put them on the line, on the security market line. Again, if I give you this A, the sigma of A is 24, the sigma of B is 0.15, the sigma of C is 0.10.
It will be CBA.
It could be, who's the first then?
C.
C, yes. So C should be here, this is C, then B is in, then A. Why? Because the sigma here is 24, and the sigma is here is 15, and this is 10. The sigma is here 10,
15,
then 15, and 24. And because of this, why I'm not talking about the systematic risk? Because the systematic risk equal. Yes, it's fixed for all of the other comparable investments. Now, A holding higher risk, and because it's holding higher risk, it's asking higher return. And this area, look at this area here, should be matched with this area. We call this area is a premium. Premium. Because we holding higher risk.
حكيت بالاول محاضره انه الريتيرن لو كان قليل بيكون الريسك يعني
قليل. صحيح؟
لا بس شوي لو حكيت بالشيء
لا في
well,
البورتفوليو
I'm not talking now about the portfolio. We try to give you introduction to the portfolio. All of them, the security market line is the portfolio. But each stock individually is not a portfolio. In other words, if we put the A, B, C together in one portfolio, it means this is a portfolio. And what should we observe? That the return should be higher any individual stock, and the sigma or the standard deviation should be lower any individual stock. Okay, this is the advantages of portfolio. When we have diversification, it means we have a higher return at the minimum risk. Okay, and if you calculate the CV of the portfolio, it must be. I'm saying about the efficient portfolio. It must be the lower or the least one according to the relative to the any other individual stock. Okay, so this is the idea of the portfolio. Now I'm trying to talk about individual stock. Then we will combine them together to form portfolio. But we cannot go through the portfolio first and go back to the individual stock, because the portfolios includes individual stocks with different criteria. And we should observe that the risk should be, the correlation should be minimum. The correlation between the risk of A, B, and C. Now for the systemic risk.
Could you explain the idea of premium?
Yes, a premium. Look at this. If we invest in B, according to the efficient market hypothesis and according to the CAPM, capital asset pricing model, the higher return include higher risk. But let's start by risk first. B is holding higher risk than A. Than C. Okay, so we will compare B and C. C is holding this risk, which is equal 10%. Because of this risk, we are asking 6% return. Okay, now for B, it's holding higher risk, and because of that, we're asking 9%. The difference between the B and C, which is 9 minus 6%, it's a 3%. This is risk premium. Why? Because we're holding 5% additional risk.
Yes.
But things not as easy as I explained in this. We should include some equations to calculate the risk premium. I said the CAPM, the capital asset pricing model. I will explain you exactly what in terms of calculations, what it means the risk premium. The R, for instance, for B, the R of B, according to the CAPM, is equal risk-free plus beta RM minus RF. Okay? So the risk-free is in here. This is the risk-free. The systemic risk. It could be here, in this case, 4%. Okay? So it's 4%. Now, plus the beta, ignore beta for just 2-3 minutes. The RM is, this is the RM, is the return of all of the securities in the security market line, or the return of the portfolio in the security market line. This is considered as RM. Okay? You can tell this is the RM, could be 10%. Okay? It could be 10%. Or could be any other. So it could be 10%. So RM is equal 10%. RF is equal 4%. Now the RI is, we know this, but according to this equation, we should know beta. Here minus 4%. The beta, look at, is the slope of this point. What exactly what beta means the fluctuation of the individual stock related to the market. Okay? The fluctuation or the movement, okay, of a particular individual return relative to the market return. Okay? So, I'm interested in this part. This part reflects the risk premium, which is this area. Okay? This is the risk premium. And because this is not a straight line, it's a function of the slope. Okay? We will consider this is maybe in the next chapter or at the end of this chapter. This is what means the risk premium. Okay, let's go back to our slides. At the end of this chapter, I will introduce you how to calculate beta, because beta, sigma and beta are measures of risk. Okay? Sigma and beta are measures of risk. Okay, we talk about the unsystematic risk. Now, the systematic risk. The systematic risk. The systematic risk includes different risk. The market risk, the general market risk. For instance, we can talk about the situation of the Gaza market, and it will influence on the individual risk. The interest rates risk, the fluctuation of interest rates, influence of the assets. Let's give you a little example here. If banks increase the interest rates, it may influence on the investment. Okay, so companies, when they are asking loans, they have to pay higher interest rates, and this is considered as a risk for the company. Reinvestment rate risk. If you generate a profit, for instance, and this profit should be reinvested in the terms of return earnings, and you don't have a space to invest, or if the investment decline in the future, it considered as a risk. The purchasing power risk. You know, from the foreign currency and from the exchange, the purchasing power is keep diminishing. You may generate $1,000 as a profit, but the purchasing power of this $1,000 is not as the purchasing power of the $1,000 before 1 year or before 6 months. And in particular, if you are living in a country with a high inflation rate, like Russia, it's complicated to consider the inflation rate. The exchange rate, if the company has exports and imports, and if they trade with the international companies, and they export for the lower interest rate countries, it means there's less cash inflow. But if they export to the higher exchange rates, they will subject of higher income or higher cash flow. Okay, so this is the systematic risk and unsystematic risk. What is the importance of the unsystematic risk and systematic risk in the terms of investment? Look at this chart. Or let's do it in. We know this, if we invest in one stock or in one security, the risk could be in here. Okay? If we add 4 stocks, what do you think about the risk? Increase or decrease? In the portfolio, we have only one stock. Yeah, consider this is the portfolio. 100% of one security. So the risk, if we add more stocks, decrease. Okay, could be decrease. So this is the second portfolio. We have 4 stocks.
decrease it.
But if we add 8 stocks, okay, 1, 2, 3, 4, 5, 6, okay. If we have 8 stocks, so it will decrease. If we have 20 stocks, if we have 40, okay, if we have 80, if we have 160, if we have alpha, what you observe? Yes, you observe. So this is the line, and the line become fixed. Okay, suppose we are in here. Okay, and we consider this is the what this area? This is systematic risk. So this is systematic risk. And what this area? This is unsystematic risk. So what you conclude in this?
The risk is decreasing, but by a decreasing rate. So
The decreasing rate.
Yes.
Which rate?
I mean, it is decreasing.
We don't
but
have
the
rates.
amount.
We are talking, this is the risk. Okay? And this is the number of securities. The number of securities.
Yes, but I mean the amount of how risk is decreasing is
Because of what?
because I think it becomes constant when the number of stocks is increasing.
Yeah.
So
The number of... So there is a negative relation
yes.
between the number of securities added to the portfolio and the risk.
This is according to diversification.
Diversification. But there is one of your observation, and you have another observation in this.
The risk will decrease till it reaches the systematic risk.
Yes, close to the systematic risk.
Be constant after that.
Yeah, so the risk keep diminishing or keep vanished till be closer to the systematic risk. And in this time, so now I'm asking you, what is the optimal portfolio? Where is the optimal portfolio? Which one? To have 160 stocks, or 80, or 40, or 20, or what is the optimal portfolio? Well, you prefer to have 80 stocks or 40 stocks? 40. Why?
Because after you increase the number of the stocks, it doesn't matter.
Yeah, not necessarily. Why it is not necessarily?
Because diversification wants to decrease
Huh?
the risk.
Yes, because if you are adding more stocks, you hold more cost. I mean the transaction cost.
Yeah.
So it could be, where is this area in here, it's not necessarily to be 40. It could be something around 20 to 40. It could be 35. In this area, is the optimal one.
Yes.
Because if you are adding more stocks to the portfolio, you are holding more cost.
Less risk, less cost.
Yeah. So we can conclude that the unsystematic risk declines as more securities are added to the portfolio.
Assuming that the investor is rational enough.
And the market is efficient.
Yes.
If the market is not efficient, then we cannot get this. I mean, the investors are rationally combined or forming these portfolios. And you remember in the last meeting, last week, at the beginning of this week, I said, if the market is not efficient, we have inefficiency in financial planning. Okay? And we take wrong decision in forming our portfolio. You will see how we connect the things together in investments. So systematic market risk not affected by diversification. Okay, it's fixed. Yes, I explained this. As more risk invited to our portfolio, see, the individual risk decreased or the unsystematic risk decreased. So we can eliminate the impact of unsystematic risk by diversification, but we cannot eliminate the impact of the systematic risk by the... And you see, in this area, you can see this is systematic risk and this is the area of unsystematic risk, and it keeps diminishing through adding more securities to our bus or our train. Okay, but after our train is full, it is not necessarily to adding more people to our train, because already we are satisfied in this case. Okay? Any question? Any question? The measure of risk. I said that we have two main measures of risk, sigma and beta. This is to your level, sigma and beta. The variability of return. The variability of return, I'm now talking about the individual risk. Again, we said this A is located in this area, fine? Now, how I measure the individual risk? Okay? How I measure this? I should use two different methodology, like standard deviation and beta. The standard deviation is the fluctuation of the stock or the fluctuation of the security. We can take this is the average, and see how the different points are far away from the average. If we compare this with another stock, is like this stock, is less fluctuated. So you can tell the sigma of this one, sigma of A, is less than the sigma of B if we are considering this is B and this is A. And if we have another stock like this, so the sigma is equal 0. There is no fluctuation. Okay? The higher the fluctuation, the higher risk. So the volatility of returns. The volatility of return relative to the market return. When we are measuring the volatility of return relative to the market return. And we calculate like this. If we have, okay, we consider like this. This higher risk, holding higher risk than this one, because its slope is higher. The slope of this higher than the slope of this. When this move like this, here is 0. Okay? Just giving some engineering items. Okay. Look at A and B. Go back to my example here, just to imagine these two things. We have this and we have this. This. Okay, we have this. We combine them in terms of parabola and in terms of on this figure. This one, because there is big distance between the points that's away from the average. Okay, this is the average. Just move this like, okay, move this chart like this. If you move this chart like this, you will have this. And move this chart like this, you will have what it means. It means this. Okay, make it blue. This one A is very wide, which is highly fluctuated. And this guy is not fluctuated as much, so the data is concentrated. Just move here, like this, okay? And move. You will see this is wide, and you see this is narrow. Okay? I know some people, they don't like this because it's related to statistics and related to the econometrics. So, but it is your luck. You accept to be in our train. Okay? Look at this stock A and stock B. Which one holding higher risk? The blue one or the black one? The blue one, because it's, yes, varies. So the data is located from 12% to 19%. But look at this one, the black one. The data is concentrated. Okay? It's less fluctuated relative to the other stocks. Okay? It's fine? Are you sure خلاص? Right. Next meeting, please bring your calculator, because I may finish the chapter next meeting. A lot of calculations. So there is no خلاص. Okay?